Welcome all to another instalment of Defining Matters. I'm Jamshidi and I'm here with fellow partner and friend, Nicole Pedler.
Okay, I'm looking forward to the discussion today.
So the defining matters. I think, Nicole, there is no greater defining matter than when a company receives a non-binding indicative offer. And we have gone through the data. Now, we're the only law firm that produces this data, gone through the non-binding indicative offers, which we'll refer to as NBIOs, for 2025. And I think there are a lot of lessons for both targets and bidders as to how things might unfold. To set the scene, why don't you just explain the sort of broad parameters of what the considerations are when an NBIO is received by a target?
Sure, Cam. And let's put it in context. I mean, when this happens is typically after market, ideally on a Friday afternoon. You know, there's a phone call to the chair, maybe to the CEO, sometimes to financial advisors if their mandate is known widely, but typically to the chair, letting them know that a letter's coming.
And so, Nicole, first thing that a board should do once they get that phone call?
First thing they should do when they get that phone call is send it on to their legal advisors and to their other advisors, CEO, and start the wargaming from there.
Sounds good. So they've received the NBIO. What's the key decision at that point for the board?
The key decision at that point for the board, there are a couple of them. The first piece is to engage or not engage. That's an interesting one. Our jurisdiction is a little different to the rules of the road in some of the others. So, for example, in the United States, there's something called Revlon duties. What you have to do there is, in effect, if you receive an offer that has the right characteristics, you are effectively required to start an auction process. We don't have that as an automatic requirement, but the board does have to diligently assess what comes in a number of different ways. They need to look at the value, very important, but also executability. Now, very quickly, the next decision point that comes is, do we disclose this or not? And that feeds into the strategic question in terms of what you're going to do and how you're going to engage, but also in isolation, whether there's an obligation to disclose it. That obligation can be shaped by a few different forces, but the first piece is if it's truly an indicative offer, non-binding, uncertain, usually subject to finance and due diligence and a range of things, and if it is also confidential, then there's no disclosure obligation. That's really critical because we have had examples in the past where there's been disclosure of offers that have moved the market and they've turned out to be unexecutable, or in some cases, you look at David Jones, 10 plus years ago, that was effectively a spurious offer and it caused havoc for a very important listed entity.
So that voluntary disclosure question, Nicole, I agree with you. I think that is one of the most critical early stage decisions, and it's one that boards really should be thinking about ahead of an approach as to how they're likely to respond on the disclosure question. Should we get into the data?
We should.
So last year, there were 27 non-binding indicative offers that were made public. And to your point, not all of them are made public. Some of them are disposed of without ever seeing the light of day. So people should keep that in mind. The 27, that's roughly in line with the previous 4 years, where there was about 33 on average during that period. The big question is, what is the success rate on those NBIOs? Our data shows that about 30% of bids or 40% of targets approached, keeping in mind a target might receive more than one approach. So about 30% of the time or 40% of targets, the NBIO is successful and ultimately it results in something that bidders can either accept into a takeover bid or vote on at a scheme meeting. So the first point I'd make is, more often than not, NBIOs are not leading to a transaction capable of being assessed by shareholders or capable of being accepted or voted on.
That's a really important statistic, isn't it? Because I think from a target board perspective, the way these things can be perceived is in a range of ways, but it does attract a level of scrutiny on the company, on its shareholders. It creates questions for the workforce, all kinds of things, which if it turns out it's going to have been an important exercise, but ultimately not one that changes the ownership of the company or is even capable of being put to shareholders, it's a whole lot of distraction that can be quite destructive in the long term.
And the share price, I mean, what we often see is if an NBIO is announced, the share price will quickly move very close to what the offer price is. Now, as you and I know, there's a lot of water that needs to go under the bridge before that value is actually realised by shareholders.
I think there's also an attraction to thinking of of disclosure. What's the case for disclosure? It's obviously that, putting out the for sale sign, that idea that you've hung out the shingle and now you're unconstrained in marketing the company more broadly. And that is true. But I think it's an important thing to assess whether that's right for a particular company in its circumstances. So sometimes, for example, that might be necessary. Sometimes it might be the case that the company is in a position where it'll be a very challenging road through diligence for whatever reasons, or financing, to find a credible executable bid, and that is going to make it much harder.
Yes.
You've really got to look at it on a case-by-case basis. It also is one to remember that bidders don't have the same types of constraints as the target once something is in the media. So targets are constrained by their continuous disclosure obligations and by the very high standard of disclosure. And in Australia, the very prolific class action situation where securities and misleading or deceptive disclosure claims are, we're one of the markets with more of those than anyone in the world except for the United States. So with our boards set against that standard in terms of further disclosures they put out, whereas bidders can background the media, they can put thoughts in and their perspectives without that level of rigour behind them, it's not a level playing field.
Well, a lot of considerations there, but I want to come back to the data if we can. So on disclosure practices, what we see from the data is that 56% of the time in 2025, parties got to an agreed transaction with no disclosure. So they were able to negotiate and do diligence under the cloak of darkness. And I think you and I are aligned, Nicole. I mean, it's horses for courses, but as a general rule, if you're acting for a bidder, confidentiality is really important to prevent the public auction you talked about. From a target's perspective, you've set out all the good reasons that it can cause disruption. And again, that's why most of these deals are being done with the benefit of confidentiality, which is sort of the preset. Now, an interesting one, despite the best efforts of the journalists in the market, only 8% of the time was an NBIO leaked, which forced the disclosure, to your point earlier, around when a disclosure is required, when confidentiality is lost. So 8%. Now, in Australia, there's sometimes accusations that we're a leaky market, and I just think 8% of forced disclosure is a pretty low outcome. So I rebut the allegation that this is a leaky market.
This is where the statistics really help. And there are obviously other situations where you can have to have the target board must make disclosure as well. So it might be that it's another bid that's come in, or NBIO rather, during the period where there's another proposal under consideration. It might be that it's a major shareholder or insider that's teaming up as a joint bid, such that the only way to proceed is on that basis, having formed an IBC and letting the market know.
So the other one, Nicole, on disclosure that I think is really interesting is the voluntary disclosure question we talked about at the outset. So the data shows that last year, 13% of the time, the target board voluntarily disclosed that they've received an approach. Historically, it's been about 20% over the previous 4 years. So a little bit down, but still a fair share of that NBIO disclosure. I think about two examples in recent time. I think about the Albemarle Liontown situation, where they voluntarily disclosed the approach. The share price went up 70% on disclosure. The parties engaged for a few months, including a price increase on the NBIO, but ultimately they were unable to form a deal and the share price tanked 40%. So disclose at your peril. Now compare that to the Oz Minerals situation. BHP made an approach of Oz Minerals on a Friday. Oz Minerals disclosed it on the Monday, immediately rejecting. What that allowed Oz Minerals to do was to go out into the market and see what shareholder views are on the price. What would be an acceptable price to sell to BHP? The other side is BHP is probably a high conviction bidder. So by putting that into the market, does it apply pressure on the bidder to come back with a revised proposal? So that statistic, I think, culminates all the considerations around voluntary disclosure. It's typically in the minority of situations, but it can be effective, has its risks.
So taking that to the next step, the board has taken itself through the point of deciding whether or not it's going to disclose, if it has to disclose. Cam, I'm interested in the stats around the next piece, the engagement period and what happens next. What did the data show us there?
Well, Nicole, this is interesting. At 2025, what we saw was that the engagement period has actually extended relative to the historic recent past. If you think about a few examples, CC Capital's approach of Insignia, the period from NBIO announcement to signed SID was 137 days. Now, you and I know that's a very long time, and I'll get to sort of what the market average is. The other one's XRG's bid for Santos. That was 82 days from NBIO announcement to effectively termination of that deal. So there are a couple of examples of very long engagement periods. Now, I generally think about engagement period, a good proxy for engagement periods, as being exclusivity periods. So when is a bidder given exclusivity to conduct its due diligence and negotiate a SID until either signing or termination of discussions? On average in CY25, it took 51 days of exclusivity. Historically, in the previous 4 years, it was 39 days. So what we've seen is an expansion in these exclusivity periods, which are a proxy for how long it's taking to engage. 51 days is about 7 weeks. Now, I think when you and I think about how long due diligence and SID negotiation takes, what do you think? 4 to 6 weeks, I'd say?
That is a fair estimation, especially in this market. I think that there is a lot of diligence being done and a lot of bidders are not wanting to take risks and have unknowns that might pop up later.
Well, in an uncertain macroeconomic and geopolitical situation, you can see bidders being cautious and possibly waiting a little bit longer to absorb the news flow, somewhat skeptically, maybe keeping an option on the deal as they see how things transpire.
Indeed. And that part of it is really interesting from a target perspective, because at that point, especially here, we're really talking about, from the data that you're collecting, is really the public situations. These are situations where there's an exclusivity period that the world knows about. That's a pretty tough moment for management teams and for boards to keep the rest of the business flowing through. And we've got an interesting quirk of the way the regime's developed in Australia that's different to other places. For example, in the UK, they have what's called the put up or shut up period. So the steps there, if you think of it in 3 pieces, is if a potential bidder is named and a target can decide to name them and trigger this period, then they have 28 days to make a firm bid. And if they don't, they're then locked out of the market for 6 months. I say locked out of the market. They're locked out from making another control proposal for another 6 months. And that was to address what was seen as, it was called a virtual bid period. And that's exactly that. We don't have that in our market. And so it is a very challenging time for a board to manage the business through. And it loops back to us really to that first question around the seriousness of deciding whether disclosure is the right path.
It also links back to your point around this slightly uneven playing field between bidders and targets, where targets are under pressure to respond, whereas bidders have a lot more optionality in the length of engagement in our market relative to other markets. Now, I want to talk about a specific situation that's arisen where the takeovers panel looked at a situation with a very long engagement period, the Hum Group situation. So why don't you take us through that?
Sure, Cam. That's one that's going on. It's live at the moment. What's interesting there is that, and taking it back a couple of steps, is that the group associated with the chair was in discussions about a control proposal with Hum. It was publicly announced in November last year that those discussions had ceased. And not long after that, a confidential, non-binding indicative offer was received from Credit Corp. That was in November. That wasn't disclosed to the market, as we've discussed. You know, that's a question and a choice for them. At that time, they chose not to form what's called an independent board committee. An independent board committee is something that can be put together when it's seen that there might be members of the board that have dissimilar interests to the rest of the shareholder base. That's a point that was under examination by the takeovers panel later on. But moving it forward a month, they had received a board spill proposal under Section 203D of the Corporations Act. And in announcing that proposal, they also announced that they had received that prior indicative offer from Credit Corp, which makes sense to have needed to disclose that in a fulsome sense at the time. The challenge then came with what was said. So what was said was that the proposal was under consideration and that there was further things that the board, if effectively that the independent board committee would need to consider. What wasn't said was that there had already been a reject message passed back to that potential bidder and that an independent board committee had been determined not to be assembled at that time. And so proceedings had followed that in the panel where it's been found unacceptable, that discrepancy. And to some degree, when you put it out like that, it's not a challenging one to see how that has become the outcome. The thing I would say is that it's really challenging even in any situation to manage the fact of a direct negotiation happening between a target and a potential bidder, and the kind of messages that need to be put forward and the kind of things that need to be said in order to try and understand the bona fides of a bidder and where they're going to take their proposal, and then what's appropriate to say in the market. But what we do know coming out of that, and which shouldn't be a surprise to anyone, is that there has to be alignment between what is actually said in private and also in public.
Yeah, and again, going back to the disclosure question, once it's public, you are a little bit more constrained as to how you can play a bidder, and trying to push, I sort of feel for the Hum board because they wanted to push the bidder for a higher price, but that didn't reconcile with the public statements where they said we're willing to engage without further disclosure around at a higher price or on improved terms.
And it is an interesting one too, because it's not a binary situation. What we have seen in the market is an incredible spectrum of the different ways that bidders can be given the soft no, if you want to call it that. Whether it's being told that that proposal's not sufficient, but, for example, if we give you this piece of management information, we'll give you an opportunity, a very short opportunity and a limited opportunity to come back with something better. Or usually it becomes a point around you don't understand something, or there's an specific issue to work through. Let's see what that could look like. The immediate hard reject without anything further, I suspect I'm interested to hear whether you've got statistics around that, because it feels like that's the less likely outcome.
The hard reject. So again, and I'm glad you brought it back to the data, Nicole. So last year, 11% of responses or announcements to NBIOs were a firm reject immediately after the NBIO was announced. That is well down on the previous 4 years, where it was about 33% immediate rejects. I've sort of grappled in my mind what's caused that. One of the reasons I think is what we saw last year was a doubling of disclosures forced by the bidder having a substantial holding and having to put a substantial holders notice out there. So that forced disclosure in 13% of the time. Putting those two stats together, I think the conclusion is when you've got a bidder that's got a substantial stake, it's a lot harder for the board to immediately reject. They have to be more nuanced in their response. So I think that's one of the reasons. The other one might be valuation questions are a bit harder in this environment. Take interest rates, for example. What are your assumptions over the forward period? So maybe boards are just taking a bit more time to assess whether fundamental value is actually reached by the proposal.
When we talk about the immediate reject, something that comes to mind is the challenge that private equity has in this space. On the one hand, year on year, we find that they make up about 20-25% of take private proposals in our market. They're an incredibly important part of it. They are very disciplined and they require a lot of information and data to make those disciplined decisions. And what that means is that inevitably they've got to put their indicative offers in, usually subject to finance. In the mid-market, sure, we've been seeing more takeovers from them, but by and large, for the larger transactions and certainly debt-funded transactions, you're going to expect that they're going to need to do significant diligence, and they're not in the same position as a corporate where, for example, if perhaps the value isn't stacking up precisely the same way they thought, they might be able to find synergies here or there. So it's a challenging matrix that they have to fill. And so in those situations, I think it's fair to say that in the press, the press loves private equity non-binding indicative offer that stretches, and we saw that with Insignia and others. And then it's challenging for a target board when a private equity bidder finds that for whatever its reasons and its requirements, that deal doesn't stack up. In this context, Cam, I'd be really interested to hear on the stats on private equity in the non-binding indicative offer space, because private equity is in an interesting spot. They're disciplined buyers. They are important parts of our public M&A. Year on year in our public M&A report, when we do the data, we find that they make up 20-25% of take privates that have happened in the year. But they require a lot of information. And if the value question isn't stacking up based on the information that they've got, then they're not like a corporate or other strategic bidder that can find the upside elsewhere. And so I think they're kind of set up to be the kind of bidder that will naturally have to make disciplined decisions here and there, that the deal is not for them despite having approached. What does the data tell us about this?
Well, Nicole, you've hit the nail on the head. This is the data point in the data set that fluctuates the most from year to year, the success rate on NBIOs by private equity. So the previous 4 years prior to CY25, 45% success rate, which is pretty good. It's sort of in line with the broader success rates we talked about earlier, 40% of targets being successful. So you could say PE bidders in line with the broader market. However, last year, that went to 14% success rate. Only one, in fact, was successful. Now, I qualify that because there's a few situations where the private equity bidder still has either a pre-bid stake or some sort of tie-up with a major shareholder that is still in effect. And what we saw last week was Monash IVF, where the bidder, Genesis Capital, came back. So I'm putting an asterisk on that low success rate, and I'm hopeful that's going to improve when we look at the data again at the end of this year. The more interesting question for me, Nicole, is where are these PE bids falling over? So a third of the time, the NBIO is rejected by the board. There's no access to diligence. Parties terminate discussion. So that's probably in line with what you'd expect. A second third of the time, the bidder is actually withdrawing voluntarily during due diligence. So to your earlier point, they are getting into diligence. As you said, it's very difficult to underwrite a fulsome price. And effectively, a third of the time, the bidder is saying, it doesn't stack up for me. Now, there are camps emerge. One camp says, the bidder camp may say the continuous disclosure rules are not resulting in all the information being out there to make an assessment on fundamental value. I think the target view might be, or the second camp might be, these bidders are not as reliable as other bidder sets because they don't have synergies or strategic reasons to do the deal. I think you're spot on. The answer's in the middle somewhere. It's target boards are pushing PE bidders to maximise price. Bidders are obliging, but with no synergies and strategic rationale for a deal, all of a sudden, a lot hinges on due diligence, and we're seeing that fall over a third of the time. Unfairly, sometimes PE bidders people are sceptical that there may be a price chip during due diligence. There were no price chips last year. And in fact, over the 5-year period, there was only one instance of a price chip during due diligence. So I'm with the PE bidders on this one. If they've got a price, they'll generally commit to that price. Now, the question is whether the equity underwrite gets you there, the equity and debt underwrite gets you there in due diligence.
Indeed. From the target perspective, I think what happens when you get into those moments, that the discussion is usually around the plan and what's happening from there. The target group will have, at a high level, and an appropriate level that they've got a reasonable basis for, meet their continuous disclosure tests on what's happening. Naturally, they're not going to be in a position to outline in fine detail something that they can't perfectly forecast themselves. And in explaining that, it's an interesting dynamic that happens with the private capital bidders as to whether they go on the journey and are aligned on that perspective, whether they have a different theory of where the business is to go, or whether they can't match it. That's often the piece where I find where the discussion on the upside might just be the case that it's not a diligence problem, but it's during the diligence and exclusivity period that they find that there isn't alignment. And the challenge there is that in the media, it's much easier to paint a negative picture around that for a target board than it is to explain that nuanced situation.
Totally, Nicole. Take privates are nuanced situations, but we're glad they're a healthy part of our ecosystem. I want to talk, Nicole, about what triggers an NBIO, and this is a new data point this year. So what we found, or what we tracked last year, was what are the indicators that a non-binding indicative offer may be coming. And what the data showed that is in 53% of the time, an NBIO came within a few months of either a senior management change, an earnings downgrade, or some other company-specific major piece of news. So my takeaway from that is targets, if you're staring into a big announcement, whether it's management change, earnings downgrade, or some other specific piece of news, that's the time to get your defence advisors on the phone and just make sure you're prepared, because the data is saying the majority of times that's when an NBIO will materialise.
That's a really interesting data point as well when you consider the increasing volatility in the market and the increasing price volatility and the large scale of price volatility that's been happening off the back of relatively, if you look at historical equivalent, specifically periodic disclosure updates, the volatility's changed out of all proportions. So if anything, I think you'd probably expand what you've just said to say that it's a wider pool of listed companies who should be considering dusting off, their preparation materials.
And totally. I mean, we see it in earnings seasons over the last probably 2 to 3 years where the market responds to a result that is out of line with expectation. There are significant price movements happening in those situations. And again, that the alarm bells should be sounding within targets at that point that we should be on the watch out for an NBIO. Very good. So we are moving on to pre-bid stakes. This is an area of expertise for you, Nicole.
Indeed. We have the privilege of surveying every year all of the takeover bids that are commenced and all of the transactions that get to an implementation deed and go forward from there, whether successful or not.
This is your infamous public M&A report. What is it, the 18th year? Coming out in July, is it?
That's the exact one. And we're getting very excited, actually, when getting into the last stretch of FY26 to be pulling the data together for that one to come out early in the new financial year. But what we see year on year is really interesting around pre-bid stakes. So last financial year, we had 78% of public deals that reached signed implementation deed or a launched bid had some sort of pre-bid support. And what am I talking about when I say pre-bid support? In half of those cases, there was a pre-bid stake. So a direct actual shareholding, the bidder had enough conviction that they've gone into the market and bought securities. The other half of those situations effectively was some sort of voting intention support from another major investor. In a few cases, there were options that had been entered into. Those are a more niche and tricky situation because the conditions have to be right. What I mean by that is that you have to have a market participant or an investor with a high enough stake that makes it worthwhile, who would be willing to engage in a confidential negotiation over something like this and in effect have inside information that means that they can't trade for a short period beyond, for example, a morning or an afternoon or weekend to discuss acquiring a stake. And the interesting thing for us has been that year on year, that is just increasing. And it's not something that we necessarily had understood to be the case until we really started to dive into that data.
The call option is a really interesting mechanism, Nicole. The data for CY25 shows that every instance where a call option was granted, the NBIO bidder was successful. And to your point, they're hard to come by, but when you can get them, they're so powerful because the shareholder can still vote on a scheme, provided you don't exercise the call option. But if a rival proposal's announced, you can put your foot on the stake as a bidder and try and deter competition. So hugely powerful.
A great example of that one was the PSC bid for Ardonna, where that was the classic of the genre where it was the actual founders who were involved on the board, who were major shareholders. So there was the right kind of insider counterparty that was there to have a discussion with.
Well, that's great, Nicole. I mean, we've covered a lot of ground here, a lot of data and a lot of great insights. For me, the big takeaway is if you're a target board or management team and you get an NBIO, you should call the market leading firm on public M&A. And we have the greatest share of that business here in Australia. We're privileged to be in that position. I know if I had an approach, I'd want to call you and have you advising Nicole.
Likewise, Cam.
Well, that's it for this edition of our Defining Matters video. We hope you've enjoyed that. If you've got any queries, please reach out to Nicole or I or any of the HSF Kramer partners. Looking forward to delivering more insights in this forum. Thanks very much.
Thanks.